With two hawkish speeches, Jerome Powell, the head of the U.S. Federal Reserve, dispelled any notion that the Fed was on the verge of slowing its rate hiking cycle, leading markets to completely unwind the summer rally in September alone. Now, investors have to price the prospect of a more meaningful slowdown and the risk of outright recession in the U.S. as well as the European economies. The U.S. Treasury market is best pricing this prospect, we believe, with the most deeply inverted yield curve since the early 1980s. This means, absent another February-style inflation shock, an increasing amount of pain in the bond markets may be absorbed by short-dated yields, creating an opportunity to gradually add duration back to portfolios, especially if core inflation peaks looking ahead. Selectivity is the buzzword in credit markets, where credit spreads remain below average and underpricing deteriorating credit quality as recessionary risks build in the coming months. As spreads widen to better price this backdrop, the 6% yields in U.S. investment grade and near 10% yields in high-yield bonds should begin to offer investors more attractive opportunities in the coming months. Fortunately for investors, U.S. equity markets have now unpriced the excessive valuations in 2021 and early 2022. PE ratios at 16 times are back to pre-pandemic averages, though admittedly short of the 14 to 15 times of the 2000 and 2020 recessions, or 12 to 14 times of the 1990 and 2008 recessions. Investors will still need to grapple with the coming downgrades to overly optimistic earnings expectations in the year ahead, however. As earnings season kicks off in mid-October, we expect these downgrades to be priced in earnest. Increased instability has emerged in the foreign exchange markets, with central banks from Japan to the UK and Australia now seeking to arrest the fallout from rising yields around the world. While more two-way risk is likely in FX, until the Fed pivots its stance meaningfully, the dollar bull market likely continues going into year-end. For more details on how we're positioning amidst rising FX, equity, and bond volatility, please visit us on ubp.com.